now. They do a great job. It's educating and connecting entrepreneurs in Atlanta in this chapter and globally. It's an honor and privilege to be part of it. So great to connect with everyone. We got a really great crowd. I think we had about 80 some people register, people all over the country, clients, referral partners, people I've met networking, and some I haven't met at all. Looking forward to connecting with you soon as well. Hope
Greg, there's a little bit of shuffling coming on your end.
Okay. Shuffling like with the screen, you mean?
Yeah, now it's good. I think it's good now.
Table, sorry. So hope you're all well and, you know, navigating your companies well through the challenges. Certainly difficult times, and I'm looking forward to sharing with you my recent learnings and trying to help you through some of these decisions on valuations as much as possible. So you see here Integgra, this is the 10th year of Integgra. It's NFL 100 and Integgra 10. Borrow that little logo, chopped it down. So I've been in valuation overall about 20 years, and you know, worked at a .com in Atlanta in the early 90s, sort of got my feet wet in tech. And I'm sorry, around the 2000 when the bubble burst. And shortly after that, got recruited to join my first valuation firm when Sarbanes-Oxley happened and the IRS created 409A to, you know, stop companies from pricing their own stock options, which is kind of scary if you think about that now. So that's been going on since about 2004. So, you know, in the last firm I worked for before starting my own in 2010, 11 was Silicon Valley Bank Analytics. And while I was there, the group did thousands of 409As for tech companies all over the country and in the world with US entities. And so I really got, you know, sort of drank tech valuations through the fire hose there for a few years and enabled me to really have a pulse on these valuations that maybe a lot of other firms and practitioners don't quite have. And that's a really important thing when it gets down to the nuances of tech valuations where traditional methodologies might not be applicable. So let's get into it. The problem we're facing, you know, or thinking about is access to capital. You know, this is a recent, very recent report from Pepperdine University's Private Capital Markets Report, and their survey indicates that access to capital is the top issue currently facing privately held businesses. So the implication of that is that the role of an accurate or reasonable valuation in the process of raising capital is essential, because it's in my experience, sitting in, you know, many pitches through Thai Angels, Atlanta Technology Angels, and others, is valuation is most often when, you know, a pitch breaks down, what causes investors to decide not to, you know, think about getting into the due diligence process further. So got to get that in a range of right. So before we, you know, talk about where we are now with valuations while in the crisis, we got to look a little bit back in terms of context where we just came out of. 2019 was a big bust from an IPO standpoint, and some of the most prominent IPOs lost a lot of value when they went public. WeWork, Uber, Lyft, Peloton. And the constant theme was the disconnect between private company, private market valuations and how the public values them. So when you think about it, you know, the VCs are really driving, you know, the valuations. And it's a very, you know, in the private side, and it's a very small group of people. And there's just sort of a game, there's a it's a process, it's a mentality, a system that's really kind of gotten itself out of whack. And when you think about, you know, the difference between the professional VC investors and the early stage angel investors is, and seed investors, that the angel and seed folks don't have to invest, right? I mean, part of the problem is that the VCs have to deploy money. So they experience a lot of pressure to participate, you know, and maybe at times when it would be more advisable to sit it out. I remember sitting with a local head of a local VC firm here in Atlanta in the mid to, you know, second, third quarter 18 when things were really, you know, hot. And they'd recently closed a fund and they were looking to put money to work. And he was very, you know, stressed, and, you know, it was a timely conversation about what should he do. He was, you know, going to have to pay unreasonable multiples, 13, 14x revenue to get into some deals. And he's like, what do you think? You know, should I do this? I said, you know, as an investor, I'd sit it out. I'd wait for a while. You know, it's gonna come down. You know, this is not a good time to put money to work. And sure enough, the fourth quarter 18 saw a big pullback, but, you know, there's a lot of money, you know, still sitting on the sidelines, and timing is important in terms of determining the ROI. And sometimes I think the VCs, you know, timing falls in their priority list. So that said, you know, one of the most telling comments that I saw during this whole period after the WeWork blow up was Adam Neumann saying, I played the private company game to perfection. That's really powerful to me, you know, saying he knew exactly what he was doing. I mean, he marketed the heck out of their idea, their business model, something that effectively was not a technology company. It's more of a real estate play, but it's like a mutual admiration society between himself and the VCs. And there's this culture in America, not just in business, but in sports. And we mentioned the Michael Jordan, The Last Dance. You know, we love to build people up just to kind of tear them down. You know, no matter how great Michael Jordan was, the Jordan Rules book came out, and, you know, he had to fight for, you know, to preserve his reputation. Newman certainly wasn't, you know, a Michael Jordan in terms of his performance and skills, but nonetheless, you know, the media, we have this culture of sensationalism. You know, we're building things up and then tearing them down. So it's not working. They get torn down when they go public, and the masses, the, you know, other smart people, the investment bankers, and individuals who are effectively angel investors on the public markets, they aren't willing to go to the valuations that the VCs go. So this is sort of the source of the disconnect. So where are we now? Coming out of that. Sorry, we're getting got this annoying bar up here. Just have to put that down there for now. Let's take a look at what the markets have done since the beginning of the year. It's not all bad news, you know. January 1st on the left here, the NASDAQ is the top line. As of yesterday, I actually heard that the NASDAQ had, this is as of 3 days ago, but as of yesterday, the NASDAQ reached where it was at the end of the year. And the S&P and Dow are lagging. So we might think, hey, you know, we're talking about tech valuations, maybe we're back. But we got to dig a little deeper. Some other good news, though, you know, the tech sector, this is just April's performance, thanks to our friends at Raymond James. Sector-wise, the bars, everything sort of recovered quite a bit in April. The end of March was probably our low. And the tech sector is the only one that's outperformed, you know, that's actually positive for the year. So again, we're thinking, if we're raising money, maybe it's not so bad. But here's the other side of the coin. Valuation-wise, the market PE is at a 20-year high. It's over 20, which it has not been there since 2001. So with earnings dropping and expected to drop for the next couple of quarters, this really suggests that we're in kind of very dangerous or risky territory, in the public market. So I think a lot of people maybe have gone back in, thinking it's a time to buy, and that may be true for the next couple of years, and the returns, when things get back to normal, may be very solid. But for the time being, the market looks like it's very overvalued, even at current levels. So poll question number 1. Amin, need your help here. What do we got?
It's launched.
Yeah, given that information, what percentage do you think that an early stage company pitching to raise money should decrease its valuation from pre-COVID-19 levels?
Awesome.
0, 10, 20, or 30 or more percent?
We'll give it just a couple more seconds. Looks like majority of the folks have done it. All right, almost. Wow.
Very, very interesting.
Are you able to see it, Greg, on your end?
Yeah, I am. So
okay,
we got
great.
25. Wow.
All right, I'm going to go ahead and end the poll.
Yeah. So pretty even distribution. That's it. That's from 0 to 30 or more percent. That indicates a very broad level of disagreement, shall we say, on this matter. 20% is the winner, and I'd say that's probably what I've also conversationally heard most people think. It's pretty hard to go into a pitch right now and have some investors who have lost a lot of their own personal money, public or private companies, ask a question: how much have you adjusted your valuation since before COVID? And they say, well, I haven't. I think my company's strong and right sector and got everything aligned. Well, it's a very difficult case to make that, the growth trajectory that we're going to, most companies are going to experience in the next year, couple years, is going to be what they thought it would be before. So to the extent that valuation is based on future earnings, and earnings forecasts are down at least for the next few quarters, that's a tough sell. So just big picture, it's a bit of a red flag, for investors that I'm talking with, both angels and VCs, to have that, they mentioned the word hubris and things like that, and be overconfident or whatever. And the response is often, look, they can put anything out there that they believe in, but probably not going to raise money unless there's some sort of adjustment and acknowledgement about the current, situation and environment. So, okay, let's close that out. Or do I close it out? Okay. So let's talk about what kinds of adjustments we should be thinking about. As a baseline, what we got from, let's look at some data. Sorry, trying to hide some windows on my side. This is from Angel Resource Institute, one of the better data sources for early stage valuations. But that said, while it's one of the better ones, data in general on early stage valuations is very hard to gather. There's not much agreement amongst different sources. It's not very timely, certainly not real time. Many times it's more than 6 to 9 month lag before we get some of this. This is the latest we have here from Angel Resource Institute is mid-year of 19. So obviously we're about a year out and things have changed a lot. So for someone just to look at this and say, well, you know, the median pre-money valuation for a seed stage company is about $7 million, you know, well, we got to dig a lot deeper. There's a lot of adjustments that need to be made and things that have to be considered, you know, from this top line number. And the first thing that they indicate themselves is that their data skews towards California, volume-wise, certainly, you know, the highest percent come from California, and certainly the higher valuations are in the California region as well. So that's always something that has to be thought about. So what other valuations? Here's the big one. You know, on the left side, we're talking about all the different adjustments we're going to go through here: stage, region, size, sector, year-to-date adjustments, and company-specific factors. So starting at stage, obviously the earliest stage deals have the highest risk. And from this chart, from, you know, CB Insights, Crunchbase, the seed stage is getting pounded. There's just very little appetite for the earliest stage investments. So if you think about it from a volatility standpoint, you know, there's a flight to quality, and investors aren't as willing to go into the earliest stage investments, and the volume of deals here in the first quarter, you know, suffered dramatically. So that implies that to attract some capital at this stage, we've got to adjust the valuations accordingly. And here's a quote from the Atlanta Inno, and that was just regarding seed stage. So it didn't list anything about angel stage. And it's very important to bifurcate these two stages and when we're talking about valuations, because they're different, okay? You know, a pre-revenue company or a minimal revenue company is a lot different than a seed stage company, and even how we define those. I heard a VC that came and visited from New York last year say, we're a seed stage fund, but we're New York's seed, we're not Atlanta seed. And I said, what does that mean? And she said, New York seed's $1 million in ARR, and Atlanta seed's 500K. So whether it's 500K, $1 million, those are driving higher valuations than angel stage companies, and that's got to be considered when pricing a pitch. So according to P.K. Reddy, who I believe is part of Thai Amin, and you know, met him over the years, his quote is, the angel community gets taken to zero right now. The other thing you're going to start to see is the out-of-town VCs that were coming here were because the deals were priced well, they were priced right, there were plenty of deals to be done in their own market now, and which means they don't need to come to Atlanta. So it's going to be even tougher for the angels. So that's stage-wise consideration. So region-wise, as I mentioned, the California factor, here's some great data in BIP Capitals, which is a local Atlanta VC report, you know, from late 18, where they showed that, let's just call it seed stage companies with $1 million in revenue that drive, you know, we're driving $8.8 million, you know, valuations in the hubs, innovation hubs, New York, Boston, Silicon Valley, Austin, and so on, versus 3.8 million for the Southeast. So that's less than half. So that's another variable, you know, to put into the calculator when thinking about a valuation pitch here. Here's another thing, you know, BIP put out there. They looked at 522 deals, you know, and this helps think about the difference between angel and seed again. The median pre-money valuation for companies less than $1 million is 1.7 million. Okay, so now we're slicing again from, you know, that 7 million top line number, national seed stage, down to Southeast, Angel, less. So this doesn't say anything about sector. And these could be a lot of retail deal or non-tech deals, but we're continuing to peel back the onion here and having to trim our numbers. So let's talk about sector now. Back in 18, when things were really hot, I kept hearing, the word, from companies, clients coming into my office in the SaaS sector was everything was 10x revenue multiples. My company, no matter what the revenue, I hear the market is 10x, and so I heard it enough times, I wanted to put some data to it. And I go into my financial software and I pull a bunch of SaaS companies and I group them by size. And we group them pretty broad ranges, 0 to 100 million, 100 million to a billion, and over a billion. And the only companies that were driving at that time when things were good, 10x revenue multiples and up were companies with more than 2 billion in enterprise value. The median for a billion and over was about 7.5. 100 million to a billion is about a little less than 3. But you can see what public SaaS companies less than $100 million were driving in terms of revenue multiples, and it was median less than 1, which was even pretty surprising to me, and it's very surprising to companies thinking about going out to raise money with $500,000, $1 million, a couple million revenue, thinking that they're worth 10, 20, $30 million. So it was a myth. It was never true for the early stage. Certainly not true now. So sector-wise, though, it's certainly necessary to think about sectors when making this group of adjustments. No question that the B2B SaaS sector drives higher multiples and higher valuations than B2C and so on, and others are more maybe fintech, which is a little different than pure financial services, or non-tech financial services, materials, other things drive much lower valuations. For a while, certain energy companies were driving, green tech and things were, even cannabis were driving ridiculous valuations. I had a woman in the cannabis sector tell me that every man, woman, and child in the world would have to buy and consume about a pound of pot to justify, the valuations that they were seeing at that time. So, certain things just are disconnected from reality, but we do have to adjust up, for certain sectors when thinking about valuations. So year-to-date valuation, this data, as I said, the last data we have is from the middle of 19 now. And if a forecast, even for a profitable company, is not adjusted, from a pitch deck earlier in the year, that's a problem. It's a little joke about this new financial metric called EBITDA-C, which is earnings before interest, taxes, depreciation, amortization, and coronavirus. We're not talking about before coronavirus. It's just throw that out the window. The world has changed. So if we can't use EBITDA multiples and discounted cash flows for a mature company for evaluation, and we can't use revenue multiples even because the revenue is too small to be, produce a meaningful answer. What do we do? How do we think about valuing? Is there any method or process to value a really early stage company? And the most common one's called the scorecard method. There's white papers out there online, and you can read about all the ins and outs and details and math. Basically, I put it into a spreadsheet and created a tool around it. But the concept is that we do an interview with the CEO or management team. Takes about 90 minutes to go through about 6 or 7 categories 20, 25 questions. And we end up with a factor, more or less than one. And to apply to the valuation that we come up with from all of the other first 5 adjustments. So for example, if we, the management team always gets the most weighting. I mean, people like to always say bet on the jockey, not the horse. It gets about 30% of the weighting in the whole process. But after we go through all this and assess the size of the market, the IP, which is very important, the competition, what marketing and sales distribution partners we have in place, funding situation, other pros and cons, we're going to come up with something, maybe say, just for example, let's say 0.75. If the first 5 adjustments led us to a $4 million valuation for a company, in the Southeast, seed stage, healthcare, IT, whatever. As of today, May 31st, we think this is worth, that type of company is worth $4 million, but this company specifics, given it's a first-time CEO and maybe there's no IP and some other things, we only give it a 0.75. We take that $4 million down to 3. So that's how we get to a specific look at an early stage, really early stage valuation. So let's look at an example. Have a little fun, do another poll. We've got a Shark Tank, question for you. You don't want, evil Mark Cuban on the right. You want a deal. Let's get a deal done here. We got to get this company off the ground. You only get to pitch, to Mark one time. You got to make it work. So here's the deal. You walk in, the company walks in, angel stage, Southeast region, pre-revenue, B2B, SaaS, healthcare, IT, first-time CEO as of today in this market. All of these things kind of, except for the sector, are kind of get the negative, value directionally. So this person, first-time CEO wants to raise 500K. What would you value this company at? And so in little review, 7 million was last year's national seed median. This is not seed, so we know that in the Southeast, it's less than 1.7 million, sort of sector agnostic. Here's a little bonus info. In my job, with my clients, I've seen a couple deals lately with actual data. I know one Series A client, a B2B SaaS company locally, raised 15 million. I'm sorry, didn't raise, but with 15 million revenue, achieved a $35 million pre-money valuation. So just a little over 2x, 45 post-money. Here's another one just recently, seed stage, B2B SaaS, 3 million revenue, just closed on a 9 million pre-money. So about 3x. So use that as a basis, guideline. Here you go, poll question number 2. At what valuation should this company in the Shark Tank, pitch to raise their capital? Less than 2 million, 3.5, 5, or more than 8?
Seems to be a small consensus.
Yeah, majority, over 50% going for less than 2 million. Pre-COVID, this was kind of thing was probably slam dunk 4 or 5 million at least. But and you'd be very surprised. We just, we're still doing virtual pitches and Thai Angels and Atlanta Technology Angels. It's a really interesting company, West Coast based, granted, with a healthcare IT thing, telehealth, even more hot now, college mental health assistance and, services, psychological services, all, asking, for, I forget which one, it was 8 or 10 million pre-revenue, pre-money. And we're like, wait, colleges are kind of cheap, in a budget issues in normal times. And now they're, really hit with this, that was a very high, ask, and it certainly didn't get any traction here, despite the attractiveness of the business model. If they came in at a reasonable number, I think they'd have no problem raising money. So you only get one chance, with most investors. So it's just, I hate to see the lost opportunities. So this is just a little additional info. I think this is the maybe the last slide, or one of the last slides. How are we doing on time? We're right around good time. Sort of where my observation, and borrowed some of this from some other conversations, but what happens in this private company game, from zero to the angel stage, valuations grow a couple $1 million. After the funding, they kind of flatten out for a bit. And at each phase, the company either fails and doesn't get traction or continues to grow. So it grows, angel seed investors, couple maybe getting up to about 5 million. Same thing happens, valuations flatten out for a bit while the company gets traction, and it either fails or continues to grow. But the profession, then the VCs come in to the mix, and as I said, competition happens, got to deploy that capital. Valuations kind of spike, but what happens after those valuation becomes problematic because they're typically overvalued. And when you get outside of that window, maybe 6 months or a year after that funding, and we've got to price those options for these companies, that typically the values start to fall because the other metrics that we use aren't justifying, the valuations that the VCs are putting on them. So they're falling for a while, and they either fall out or they start to earn out those earlier valuations and start to rise again, and the game, continues. So a Series B happens and get a big spike, and now this time, instead of flat, falling a little slowly, the spike tends to be a little sharper because they're getting, higher and higher on the valuation side. So the game is becoming more dangerous, and companies will again either fall out or continue to, the VCs have to start to decide, this company's not doing well. Am I going to cut bait, or am I going to prop this thing up until hopefully they figure it out? And what I've noticed quite a bit, and I want to dig into, see if there's more research on this, but after a Series C, if a company hasn't figured out their business model, it's a big red flag. It's danger, danger zone. So my theory is that most companies after Series C, if they don't start to become profitable, they may not ever become profitable. These Series E's, F's for hundreds of millions of dollars, these moonshot things, that SoftBank's, Vision Fund, and all these, very, aspirational ideas. We're going to see some bigger, WeWork type flame outs, maybe mini WeWorks, even locally, in my opinion, in the next short period of time. And maybe some of that's going to be accelerated by the current market, but I don't think it's only because of the current market. I think that, in some ways it might be an excuse for some companies to bail out, in my opinion. So conclusions, suggestions, what can we do to, take advantage of this crisis? I heard an interesting comment this morning that the Chinese symbol for a crisis is 2 strokes. One is for danger and the other is for opportunity, or something like that. So we've got to, find some opportunities in this crisis. And the two that I'm seeing most often are strategic opportunities to do a 409A as of a March 31 valuation date when the market was at its lowest, to, even if it's out of your annual 409A cycle, to get some lower option prices for employees, to give them some more incentive, to come out when we come out of this thing, because otherwise the options that they have are going to be far underwater, and there's just not going to be much, drive or motivation to really recover and push to an exit. That's one thing. And another is on the trust side. Many executives, CEOs will gift shares in the company to a trust and take advantage of minority ownership interest discounts on top of the current market discounts to gain some tax benefits, versus transferring them, at much higher prices and higher taxes, down the road. So there's two things that you can do. And another thing is, look, if companies don't like, the current valuations that they're getting, convertible notes might be a more attractive option right now. Historically, as we see here, investors, typically prefer the preferred stock deals. They like knowing what that valuation is when they put money in. But maybe it makes a little more sense now to push that, out a bit, kick that can down the road until things normalize, and we can agree that, it's just not advantageous, or it's too much of a disadvantage to the company right now and the founders to do a million or two, $1.5 million, $2 million valuation. That'll give too much of the company away. Let's just, do a note, try to get some traction, and revisit the valuation, down the road a year or two. Safe notes, on the other hand, more common on the West Coast, haven't gotten much traction here. There's just not enough, aren't enough terms to interest in investors without any interest rate or caps or discounts or any. I mean, it's just hard to, it's a hard sell, relative to other investments. And finally, after we think about all of these adjustments and nuances in these valuations, and the risk of getting it wrong, please don't, capitulate or try to be penny wise and pound foolish and use like a free or bundled kind of software package with a group that, this isn't really their primary expertise. I put my financials into one of these things one time, and they told me I was worth $3 million. So if somebody wants to write me that check, I'm willing to go. But you just don't want to risk, getting it wrong. So my rates, fees for these things are very nominal. Reasonable compared, especially for these early, stage worksheets. Spend a little time with you, give you some confidence in your pitch. Say that it was done, you got independent help with it. Take the deer in the headlights look out of your eyes when you're up in front of these sharks, and stand your ground. So with a defensible number, it's worth the investment. But I understand that startups are cash strapped and don't want to pay PwC or Big Four or even, big accounting firm or big valuation firm rates. But that's why I set myself up the way I do, to be able to work with you and serve this community that I enjoy working with so much. So look forward to connecting. I think it's time for questions.
Nice. Appreciate that, Greg. So we'll go ahead and dive right in for the last 15 minutes on questions. So everyone, appreciate you guys sending your Q&A in. So continue that coming. If you want to speak on live, just raise your hand and we'll bring you on. First question you have is from Sri. Isn't this a good market for certain markets?
A good market for certain sectors, I guess is what you're saying. So yes, I mean, so that's a good question, because certainly deals are getting done, but there's a much greater deal, sector concentration right now. So certainly telehealth, healthcare IT, conferencing, even I saw video games, people are staying home playing video games. They're getting, better traction right now. So in certain sectors where you can obviously make a case that things are good, it could be a good time, but say those are the vast minority of sectors. A lot of companies are getting scooped up, or struggling. I was shocked to see Groupon's valuation lately. They're actually worth less than zero. I mean, and think about how high flying Groupon was a few years ago.
Jason Perez has a question. So I think this was reference to a slide that you had shown. Are the deal structures showed on the current slide representative of Atlanta or the national market?
Deal structures, that's a national pie chart. Yeah.
Okay. So Dan McCain has two questions. So it's kind of, I think, a follow on. It's the question number 2. So for the first poll that we did, what if you were performing on the same trajectory post-COVID as you projected pre-COVID? Deal flow stayed the same or increased during March and April, that period? And then the follow on is, if you're pre-Series A and pre-$1 million in revenue, but past seed would make sense to raise a note via prices, especially considering the pre-post-COVID valuation discussion.
I'm not sure I followed that one. I'm going to do the Trump thing and ask for one question. Let's just go with the first one. And I think I saw your email this morning. Was it Dan? We can talk offline about the details. What was the first question?
For poll question number 1, what if you were performing on the same trajectory post-COVID as you projected pre-COVID? Deal flow stayed the same or increased during March and April, that period? I don't see.
Well, certainly it's a positive if you can demonstrate stability, in your business model during these times. And the deal flow, as we showed, was for the seed stage is dramatically down right now, and I would expect it to recover at a proportional rate when things get better. But the question is, when, and it seems like it's going to be a protracted recovery.
Larry White has a question. This was in reference to the second poll. Did the poll company valuation have revenue, prototype, or beta? May have been there, but did not see the key variable.
I think we said it was pre-revenue. Yeah, it was pre-revenue, first time CEO in healthcare IT. So.
So this was sent by Anonymous. Isn't valuation something that should not be affected or should not be offered by a founder, rather something to negotiate and set by a more professional / institutional investor?
That's a great question, and there's disagreement at the highest levels of thinking on that question. I actually hosted a panel, a very interesting panel, about a year ago through the ATA, Atlanta Tech Angels. I was at the Morris Manning offices, and on the panel we had 2 great, prominent angel investors, Sig Mosley and Bob Kramer, and we also had 3 founders, a couple of my clients and one other. And that was the question, and Sig and Bob disagreed on that. I think it's, I can't remember which said which at this time, but one said they, he likes the company, the founder, to show, knowledge and, and have an opinion and a justification for it and a basis for conversation and negotiation. And the other said, no, it can just disqualify you if you get it wrong. I know what I'm willing to do, and I don't need that. So, it goes 50-50. Personally, I want to see some understanding of it, because otherwise I think you can get taken advantage of it as a founder with sharks that are looking for, a below market deal.
All right,
My
thanks,
opinion.
Greg. So Stephen Walden has raised his hand to ask a question. So Stephen, you're online. You have to just unmute yourself.
Can you hear me?
Yeah. Hey, Steve.
Hi, Greg. Thanks for doing this. I'm just curious, and I ask this to the investors, to the angel investors who are actually part of this group. How many investments you've done in the last 3 and 4 months?
Me personally?
No, I'm asking the investors.
Other investors? Yeah, I'm not sure how we can.
They should be able, if they can share anonymously. Good question, Stephen, but I don't. You
Okay.
should be able to see if whoever
Because
wants to ask, they can answer at the chat.
Yeah, because I think in this, it's a question of supply and demand. And I think that from investors, we got to look at the supply side of money. And a lot of the conversation has been on the other side of it. And I think that if the actual supply of money is very low, of available money, that will dramatically affect the valuation. And I'll just speak personally as an angel investor. I would normally have done maybe 2 or 3 in this period, and I have done 0. And I feel terrible about the entrepreneurs who are looking for money, but I just cannot, in a world that has this much uncertainty looking into the future, I don't want to commit money until this thing clears up a little bit. And that's just the perspective of one investor.
I agree, and that was, I guess, part of the point of that slide that showed how dramatically the deal volume in the seed stage has dropped off relative to the other stages. And personally myself, I have put money into a few deals in the past few years, but my appetite right now is also very low, and I haven't done anything during this time, and it would take an incredibly attractive deal from all perspectives, product, entrepreneur, valuation, to even, whet my appetite right now, I think.
All right, Greg. Larry, you're next after Robert, but Robert, you're on for your question.
Yeah, well, Greg, this is Bob Kramer. Thanks. Hey, I think I was in the camp that said companies should early stage companies should tell a valuation that they think
So.
is reasonable. But if they come in way out of the ordinary, then it's really not going to backfire. But I do think it's important to note that while times are tough, we here in Atlanta, if we all run for the hills and don't support our tech community, it's really going to hurt us for a long time to come. And it is incumbent upon both founders to be reasonable about valuation. It's incumbent upon our angel community to stay in the game, to continue to support these companies. We've made great strides in our tech ecosystem over the past 8 years. But if we run into a rough patch and run for the hills, then we're kind of a pretender and we're not a real vibrant tech community. So I think everybody has to do their part to keep us moving forward.
Yeah, I agree. Everybody doing their part means being reasonable on both sides. I heard, read one article where a founder said, the VCs, and this isn't angels, but the VCs are really putting the screws to us right now. They're taking deals off the table that we were working on before this. I'm like, they're renegotiating. And of course they are. It's not putting the screws to anywhere, but it's just things have changed. So, look, valuations were too high before. For a pre-revenue company to be, more $7 to $10 million, it's just not interesting to most investors around here, at least. And so if we can, use this as an opportunity to correct that and get, valuations back to a place where there's reasonable upside for investors and get companies, going, and stop worrying about their valuation, but just kind of get to work, I think we'll all be better off.
All right, Greg, we have Larry on to ask his next question, then we'll go back to the Q&A box.
Hey, Greg, thank you for doing this. Long time no see.
Yeah.
Glad to have see Steve Walton going, and of course I see Paul Lopez frequently. Greg, I'm from the David Cummings School of Pre-Seed Valuations, which he says if they have a prototype, $1 revenue, or at least one customer strategic partner, that valuation generally can be 1 to 3 million. Okay, and of course where you vary between 1 and 3 million is the sophistication of the prototype, the cost to get that prototype built, and or the acquisition of 1 or 2 customers. And that certainly separates the class from others that just have ideas and are really raising funds to, quote, build a product or marketize a product that a consumer will buy. And so I think that since this is the pre-seed, pre-revenue is such a high risk area, that the emphasis on David's emphasis on the prototype and the sophistication of that is extremely important to that valuation.
Yeah,
does that sync with what you're seeing?
Yeah, I don't disagree with that at all. I think it was Bob Kramer just this past week in a chat we had, if I can quote you, Bob, saying, I don't think anybody, at this time at least, should invest in a pre-revenue company, at least right now. I mean, the risk is so much higher. Valuation goes up, exponentially as soon as traction is made. And the more traction, the higher the valuation. People come to me and say, well, what can I do to get my valuation up? Go sell something. That's the answer.
Well, yeah, I understand that. But that leaves the burden on the entrepreneur to raise all of the funds prior to revenue.
Right.
Which is the major gap that we're facing. I understand VC, well, forget VC, but I understand legitimate angel pools like Ty has. I understand that sophisticated angel investors always want to wait till there's revenue.
Right.
But that assumes that how do I build that prototype? How do I build that customer? That's the toughest part of the whole entrepreneurial game.
It's good to demonstrate some skin in the game, I would say, so
Sure.
Bootstrap for a while. And for companies that fear, giving, too much of the company away or diluting themselves too early, the best advice, and that means by not, I need a higher valuation because I don't want to sell too much of my company. Well, bootstrap for as long as you can, until the pain just becomes too great to go, spend any more of your own money. But the more traction you get, before you go raise money, the higher valuation you're going to get, and the less of your company you're going to have to give away. So it's, the best practice is to raise as little as you need in each round. Don't go for, taking too much money early at a big number, because that's just going to put more pressure on you to have to deliver the traction and set yourself up for failure, and being forced out of your company before you want to, and it's your baby. Take as little as you need at a reasonable valuation, get going, get some traction, then come back for some more once you've demonstrated traction at a higher valuation, and net, you've sold less of your company, you're keeping more for yourself.
Thanks, Greg. We're getting close to that 1 p.m. mark, so if you have to jump off, that's okay, but we do have some questions that are still unanswered, so we're going to go ahead and answer those. Madhu asked if Some businesses are unable to forecast 2020 numbers with any confidence given the COVID situation. How would you value a company given the uncertainty?
Mm-hmm. Yeah. Forecast is not playing much of a role right now. I think most people are kind of throwing 2020 out the window unless it's one of these few sectors that's actually benefiting. I think, as the scorecard method categories suggest, you're betting on some of those other variables. You're betting on the jockey, the leadership team, how complete is that team? Do you have the right people in place? Do you have some key partners in place? Are you distributing through Amazon or, some of your key industry partners? Do you have that IP that you need, to protect your idea? Those kinds of things. You're looking bigger picture, I think. So forecast right now is not that meaningful, and most other times they're not that meaningful because they're not that practical or realistic.
David asked a question on valuation. So a good comp and cost of capital data is critical. What data sources do you consider indispensable?
Data sources. So who's asking that question? David?
David. Yeah, David Witherspoon.
Witherspoon. Okay, a few Davids out there. Oh, hey, David. It's been a while. Data sources are interesting. Having, practitioners have to make a choice, up front, if they're going to invest in a data feed, which can be very expensive from a source like Capital IQ, but it's 100% reliable and you get it at the click of a button. But do you want to spend 5, figures and much more to get that? To me, the answer was always yes. I hated writing the big check, but I can't spend time or my people's time thumbing through, manual 10Ks and Qs and inputting things, maybe getting them wrong. So a data feed to me was essential. Fortunately, there's some lower cost alternatives, and I'll give my good friend Chad Sanstead at Tagnify a plug for a great data source for public and comps, as well as private company transactions. It's at a fraction of what was available from some others. So that's my most essential data source.
Thanks. Munder asked, and I'm going to try to phrase this question properly, is does having a single founder versus a team make a difference? What is the expected contingency plan with having just a single founder?
Sure, it absolutely does. That category in the scorecard is the founder and team, and the extent to which you have, a VP of sales and a CTO in place are very important, and some engineers, developers. Founder, and a PowerPoint is going to be, going to drive a lower valuation than a complete team, for sure.
This is an industry question. So Rahul had asked, what is the outlook of streaming media companies in terms of multiples? Content is being produced, advertisers are having issues, but subscriptions have been increasing dramatically.
Not sure I can answer that off the top of my head in that particular sector. It's not one that I've seen lately or researched, but we can go offline and dig into that. If you'd like.
And Greg we will be sharing Greg's contact info on the follow-up. So JC asked, how do you think the environment around social impact investing will be in the coming months? With the understanding that pre-revenue investing will be common or unlikely, how can a seed level startup look more promising for securing funding?
I guess the short answer is have a reasonable valuation, make it interesting to us investors. Something at $2 million is going to make me think about, ask follow-up questions. But if I hear, 8 or 10 million, our community, it's just, it's kind of a head scratcher right now.
All right. There's a couple more questions, Greg, but I think they were asked anonymously. So for anyone that asked any questions that you would want to connect with Greg on, so that he can give you a much more intimate / concrete answer with data, and you guys can have that dialogue. We will do a follow-up to share, the kind of the breakdown of everything that we covered, and and Greg's contact information as well. But thanks to the last 50 that's still stuck on answering. And Greg, appreciate you doing this and making the time. Any parting words for 30 seconds before we end it?
I got nothing else. Thanks very much. Really enjoyed being on with you all. Tried to reach out to a lot of people during this time, but this is the best way to reach a large group. So follow up with me. Let's connect.
Thanks, guys. All right. Good afternoon, and all. Have a great weekend.
Thanks.